All right, guys, let's quickly take a look at what we can learn from the latest CFTC update that we got on Friday. Now, as always, just a reminder that the data that we get from the CFTC on a Friday only shows us updated positioning info until that relevant week's Tuesday, which means that we always need to consider the price action that takes place between a Wednesday and a Friday to assess whether price have seen big moves which might alter the positioning information. Now, even though last week, Monday, if we just quickly go to these charts, looking at FX pairs, even though Monday and Tuesday saw massive moves across major asset classes, both of those 2 days that saw the biggest moves are included in this week's data, which is great. And the moves that we did get between Wednesday, Thursday, and Friday were much smaller, which meant that where positioning was updated on Tuesday and where price trades right now, we haven't really seen much of a difference. And that's very helpful because it means that we should be able to look at the positioning data in a week like this more at face value compared to what we had last week. Last week we had to do quite a lot of mental gymnastics, trying to adjust positioning in real time, if you will, looking at the positioning data and then assessing that in line with the price action. And I don't think we need to do that this week, which is great. So let's quickly take a look at where we stand on the positioning side then. Let's start with the big one, the Japanese yen. The yen remains the biggest net long after the push we saw last week. And it's worth noting that the positioning update came after the reversal that we had. If you take a look at this, we had quite a decent reversal to the downside last week, obviously looking at yen pairs across the board. Despite that, positioning is still looking pretty insane here at these levels. Take a look at this chart of the yen. Let me just quickly go there. Massive build up in longs, and yes, you could argue that there is still potential some unwind to happen, especially if you consider, the size that some says the carry trade had run. But even then, the markets, this isn't just a lot of players dumping shorts. I think that there's a ton of players that got long, and they potentially got long right at the lows, as they normally do. And I do think that might see a bit of struggling for the yen pairs to continue pushing lower. Don't get me wrong, I still think that there's more downside to be had for yen pairs, especially if the dollar, or not the dollar, if the Fed starts their easing cycle and starts to ease. That should, we spoke about the carry trade before it was even a thing, right? We spoke about trading pound yen lower. We had a decent trade with pound yen to the downside when we started to see the markets contemplate whether the carry trade was still attractive or not. So I do think there could be more potential to trade this. But what this data does mean for us, it doesn't mean we want to just go, short the yen for the sake of shorting it. But it does mean that new longs might want to just be a little bit more careful on chasing the moves in the yen pairs, at least until we see decent enough pullbacks from where it would make better risk reward sense to buy the yen from. So, for example, let's take a look at a few pairs then, just to show you what I mean practically. In terms of dollar yen, nothing wrong with looking for potential shorts, but, if we were, let's just say we get CPI surprising to the upside for the US this week, for whatever reason, then potentially looking for shorting it here is fine, but shorting it back up at 150 or 151 or 152 would just be so much more sexy from a risk reward point of view. So, just keep that in mind about some of these pairs. We've seen really big moves, and with positioning looking like this right now, I would prefer to wait for potentially slightly deeper pullbacks to trade it with, or for really good catalysts to get on it on the long side. Now, in terms of the other one, the British pound, this was an interesting one on the positioning side, because positioning data we received on Friday showed us that sterling was still well within stretch long territory. If you take a look at not just at this bar chart, but look at the historical data here. We are still well within stretch long territory. And what's interesting about this is that it happened with positioning information updated at the lows, right? So if we go to the strength chart here, you can see, or the index chart here, you can see that is where the positioning was updated. Meaning that despite what was a massive capitulation to the downside, despite that entire move lower, the market being up, with positioning updated literally at the lows, is still crazy long despite that liquidation that we had. So what does this tell us? Well, it tells us firstly that the markets are still very long sterling despite the push lower. And it also tells us that the bigger reaction in sterling to the slew of data we have for the currency this week arguably will be bigger on a miss in the data as opposed to a beat in the data. The market ought to be more sensitive to bad news compared to good news, or bad data compared to good data. Right now, I mean, money markets, if you take a look at pricing expectations, I mean, take a look at this. That's not the one. Where is the rates information? Sorry, guys, I had that somewhere. I had to close down a few of these charts. Let me just see. Here we go. So if you take a look at rate expectations for the BOE, I think the markets are way too hawkish here going into the September meeting. I mean, cut probability only at 41% versus 58% probability of a hold. With the market seeing this amount of downside and still staying this long, and the markets, in my opinion, like I say, too hawkish here. For me, it means that what I would like to trade in a week like this would be downside surprises for the likes of CPI and downside surprises for the likes of the wage data that we get tomorrow. So that'll be my preferred way of trading in. Doesn't mean pound can't go up if it's good data. I don't know whether I want to be buying it. If we do see good data coming out of it, I would prefer to look for additional shorts based on what we're seeing across things. It's not just positioning, right? It's what the markets are priced for the Bank of England. It's looking at positioning. It's looking at the price action. There's a couple of different things in play here, but I think the biggest surprise will be bad data. It won't be good data. Then let's quickly go back. In terms of the dollar, another one that was a bit of a surprise for me, the dollar aggregate. Last week I suspected that the push lower in price following the update that we had in positioning data would mean that this week would reveal that the dollar has moved into stretched short territory. But I mean, we're not even close to that right now. We're basically stuck in neutral for the US dollar, which is good for a week like this, I suppose. Going into CPI, it means that trading the dollar on either the long side or the short side this week makes sense, right? So I think that is good news for us. Apologies, guys. Struggling with a bit of a flu here. I do think that means, the dollar is tradable both on the long and the short side. So I suppose that's good news for us for CPI. Then the other one worth mentioning is the Kiwi dollar. Now, this one did move in line with our expectations after we compared positioning and price action last week. We expected the data this week would show us that it moved into stretch short territory, which of course is the case. Now, what does that mean for us in a week like this? Firstly, what it does not mean is it doesn't mean we just want to go buy the Kiwi just because it's stretched on the short side. That's not how we use this information. We've said that many times, right? This info simply tells us that the markets are already very short this currency, which means that the currency might be more sensitive to good news as opposed to bad news. Now, recall last week, our preference was to buy the Kiwi if the labor data came in stronger than expected. And we didn't want to short it because we thought the markets were already adequately short. We didn't want to short it on bad data. And that played out quite well. I mean, we had a decent opportunity, as you guys know, to short the Aussie Kiwi. Nothing fancy, just a simple trade out of data which made sense based on positioning that was stretched. Now, coming into a week like this, it's basically the same, right? We've now only gotten the confirmation, or we've got the confirmation that we thought was the case last week in terms of positioning. We have that now confirmed, and that means I would prefer to buy the Kiwi on a potential more hawkish than expected RBNZ this week. And I'm not too keen on shorting it if we get a more dovish than expected RBNZ. But let me just caveat that. If the bank is dovish enough, I would look for shorting opportunities in the Kiwi. But it will largely depend on how aggressive they come in with their OCR projections in terms of how much cuts they see happening. But the bottom line is, the bank would need to be a lot more dovish to see me excited about shorting it. Right now, money markets are skewed. If you take a look at this, money markets are skewed towards a pretty decent probability of a cut. And that goes at odds against what the economist community believes. So there's going to be a lot of volatility coming out of this event. But my preference here would be for them to actually leave rates unchanged and to trade the Kiwi higher on the back of that, purely based on how stretched positioning is. But I will have more to say about that tomorrow when we do our preview, of course. Now, the other one to consider still here is the Canadian dollar. I mean, it's still massively stretched here, guys. I mean, it's at historical short levels here for the CAT. The market is historically shorted. It doesn't mean, again, we want to just buy it for the sake of buying it. It does mean that we don't really want to be shorted right now, and we would prefer tactical longs if we got really good data or really good positive catalysts. There is no such catalyst right now. The market is pretty boring this week when it comes to Canada in terms of the data. So if we don't get anything like a good catalyst coming out, I'm just going to stay patient on it. But it's not something that I would be holding on to shorts with right now. It's just too stretched for my liking. Now, in terms of other markets, commodities, let's touch on there. Precious metals, I think, is worth still considering here. Both gold and silver still showing us sizable net long positioning here. I think it's something for the bulls to keep in mind, and it does mean that, arguably your risk reward favors more downside than upside from here. But it's also important to remember that precious metals have not really been trading in line with their usual fundamentals for the majority of this year. So I am staying on the sidelines with them personally, but I do think it's worth just keeping in mind that these things are still fairly stretched on the long side. Now, crude is the other one that was quite interesting. Crude moved into stretch short territory in line with their expectations last week. We said it's highly likely based on the price action that crude would show us moving into stretch short territory, and that of course has been confirmed with the data this week. Now, last week we said that based on the the demand outlook, based on positioning, based on over-exacerbated volatility prices, there was a couple of different things we looked at. We preferred to trade, WTI on the long side. It worked out fairly well last week. We had a real decent pop to the upside in WTI. Still continuing on that run to the upside, but we took our remaining profits off the table on Friday. I didn't want to have anything run over the weekend, so at least it played out quite well. And with the currency now confirming straight short territory, we could see some further potential upside here for WTI. It's definitely something worth keeping on the radar. Now, the other one that I think is quite interesting here right now is copper. And if you consider copper, copper is now in neutral territory on the positioning side. And that's quite significant because remember, a couple of weeks ago, we were flagging up copper so many times saying that at these levels, it's crazy stretched on the long side, and there was always the risk that the markets goes through a little bit of a liquidation, a little bit of a capitulation. That's how these things normally fade out, right? And I mean, copper has had a ton of downside since we topped out back in May. We've had a huge capitulation to the downside. We've basically given up. How much? Let's just measure that for a second here. We've basically given up. Where are we? We've basically given up, let's just call it 80%. 80% of the move that we had to the upside. And has anything really changed for copper in this push to the downside? I think two things have, but not really the broader fundamentals. The one thing that has changed, obviously going back to May, was the economic data, right? We started to see some downside surprises for US economic data on a trending basis, which left us very, cautious in terms of the demand picture. If you take a look at the City Economic Surprise Index data, that blue line that we had surprising to the downside in May going into June, July, that was US data surprising lower. So there was that, that little bit of a growth, negative growth or demand surprise playing into copper, which I think is one of the reasons why it pushed lower in the short term. And then obviously the other reason was just massive stretch positioning on the long side. Now we are fairly close to neutral territory. I would argue more into neutral, more closer to the short side after the price action we had last week. And what has really changed for copper? In the short term, the demand prospect arguably has slightly improved after last week's data. The markets went into a total frenzy, freaking out about a growth slowdown, which last week wasn't confirmed by the data, at least the few data points that we had. The demand picture doesn't look as bad as the markets feared it did. And in terms of the broader fundamentals that should be supporting copper in the long term, things like the AI development, the green transition, EVs, all of those things are very supportive for copper. Those things didn't change since May. Those things are still in play, but obviously the demand picture changed, positioning changed, and both of those two things have now changed for the positive again. The demand story is not as negative, and in terms of positioning, we're basically neutral. So I do like the odds of playing for some upside potential in copper, because we are still in a very crappy liquidity volume situation right now in terms of summer. I am, as you guys know, scaling down on risk on all of the trades that I'm taking. So if this one gets taken out, it's really not going to hurt the bank at all. But I do think at these levels, with this huge test of that key support around 394, I do think it makes sense to potentially position for some upside here. If obviously this is the potential turn, we might see the markets just smash right through this. If we get more bad, manufacturing data out of the US and obviously out of China, then we could easily see price breaking below those lows. And I'm sure I'm not going to be the only trader that gets long here. The one thing that I am a little bit uncomfortable with is I'm assuming that there will be a flurry of retail activity trying to call the bottom here. And that's always dangerous, right? We might see a flush out of longs only for the price to return back up. What I mean is we might see something like a false break, right? We might see the markets go up a little bit, getting all of us excited about a bounce, and then doing this, and then doing that, and then we have a move to the upside. That type of false break activity, it happens all the time, right? So I might be getting in here at the worst possible time. I might be joining too much of the retail crowd here when that happens. I don't have data for that. I'm just assuming that I won't be the only one here. So that's just something of a risk worth keeping in mind. But I do think we are at some interesting levels here with positioning changing and obviously the demand outlook changing a little bit more positive this side round compared to what we had back in May. So that's just a quick update roundup of what we had from the CFTC data. As always, any questions, don't hesitate to let me know.